Steve, are lower yields a sign of prosperity? Price up, yields down, equity market booming. Does that mean prosperity?
Well, it does for the people that are invested in the right products. I'm afraid to say the answer to you in real economy terms is it's not good, is it? It can't be good. The fact that we have to have low rates for longer is not good for ordinary people. So it's probably only fueling the divide. It seems to me that assets are doing well, and who would have thought equities and bonds and even FX all going in the same direction. But is it good for ordinary people? Probably not.
When you look, Steve Major, at the yield call that you've made, it's also not only the vector, it's the persistency of the call. Do you just assume financial repression forever?
Well, yes, we've always had a two handle on our 10-year Treasury forecast for as long as I can remember. And I'm talking here 6, 7, 8 years. So we've always resisted the idea of going to 3 or above. Others have been talking about 4, of course. But it is a Japan scenario. And I get a bit tired of talking about it, but you've had 20 years at 0 in Japan, and every person who denies the similarities is found wanting, because each year that goes by, I find more and more evidence in terms of debt and demographics and technology, all supporting the structural view of low for longer. So look, we have these kind of cyclical patterns. It could be that at the moment things are a bit better than last month, but that doesn't really inform the forecast for the 10-year Treasury. It's a 10-year instrument. We need to be knowing what's going to happen over the next 10 years. And so, you know, I think that much of the industry seems to be looking at the noise and the incoming data on a day-by-day basis. What we're trying to do is look through that noise.
OK, and in terms of looking through that noise, good morning to you, Stephen. I spoke to Andrew Wilson of Goldman Sachs Asset Management this morning. He said that if for him the hurdle to a cut by the Fed is still relatively high. You don't seem to think so because you've got cuts in your forecasts then. Why do you think the hurdle is as low as it is?
In terms of the hurdle, I focus on what's already priced in. So that's 2 cuts at least. And the curve in the forwards has steepened 30 basis points in 6 months. So the hurdle for steepening in the spot is already high. What I think is interesting about this is that the next easing, if and when it comes, doesn't have to be a rate cut, does it? It could be QE. I mean, just because the previous pattern and sequencing was rate cuts first and QE second, who's to say that that's repeated? It probably is, but I'm just throwing it out there. We don't know, do we? We're assuming the rates will be cut. But the Fed has already signaled that the balance sheet is not going to be shrunk as much. By their very actions, they are a buyer of treasuries, and they prefer the treasuries to the mortgages. So I look at this and think that Ben Bernanke has written the playbook for this last year. So since he left the Fed, he's been writing a lot about the unconventional policy measures. And there is quite a splendid toolkit. So future easing doesn't have to be a simple rate cut.
OK. And what do you think of the Fed, the way it likes to think about monetary policy around interest rates as separate to what they do with the balance sheet? I was listening to the recent press conference that Jay Powell gave and still drawing quite a distinction between the uses of the two. How do you interpret that?
Well, I guess intellectually it's good to have some separation, but we can't deny the fact that when they do QE, there's a big grab for duration. So they're swapping high duration for low, and there's a very, very strong signalling effect for the market today and going forward. So the presence of a large balance sheet means the Fed and other central banks have got skin in the game, if you like, and it's kind of underwriting the low for longer view, because they are long the market. They're hardly going to hike against themselves, are they? So they have the biggest position on the street.
Steve Major, very quickly here, the great fear of the people opposite of you is we're going to see an abrupt drop in price and higher yields with an emphasis on the word abrupt. Are we going to see abrupt, or do you have time to manage your portfolios if things flip?
Well, you've got 6 months of low inflation, and I guess the inflation pipeline might tick up a bit in 6 months' time. Abrupt moves, no. I mean, I've met a lot of people the last few months who all want to buy on weakness. The people I met last week, when the yield was 2.4, said they were buyers at 2.5. So I wonder where they are today. I mean, the fact is people want to buy stuff that's cheap. Looking at the yields today, this could be one of the last chances to buy. And yeah, if the Fed's on hold for a few months and the next move some stage next year is down, then you want to be long, don't you? And the question is, do you buy now or do you wait for bonds to cheapen?